Hello, everyone, and welcome to the Inside ETF's weekly webinar, Alternative Harvest, Adding the Green Rush to Your Portfolio. My name is John Swolst, and I'm the Vice President and Head of the EMEA business for Inside ETFs. I will also be your host for today's webinar. It's all the high right now with marijuana investing theme making its debut in the U.S. market with funds like the AdvisorShares Vice ETF Act and the ETF Managers Group Alternative Harvest ETF MJX. I believe today's webinar comes at a very interesting time as the largest cannabis market in the world came online in January 1st in the state of California. What will this mean for investors? What will this mean for the industry? How will they all profit from this growing market? What are the risks? Those are all some things that we're going to go ahead and cover today, especially as we take a look at things such as the big hurdles that remain with the Attorney General and the federal government refusing to legalize marijuana across the board, limiting access to banks and things like that. Certainly presents some interesting risks when it comes to looking at these ETFs. But despite all of that, in both the U.S. and Canada, assets are surging. Again, they're flowing into funds like ACT Act, MJX, and up in Canada, HMMJ. So investors really are embracing these ETFs. And as we get into those, I'm joined by two experts today that can really give us the insight into both of those ETFs. Tom Sarafingas is an ETF analyst for Bloomberg Intelligence. Prior to joining Bloomberg, he held roles in the ETF group at both Oppenheimer Funds and Index IQ. Previous to that, Tom was in the product development at NASDAQ, where he worked on creating innovative indexes for ETF sponsors. Along with Tom today, I'm joined by Andre Stracone. He is responsible for ETF and options research in TD Securities Equity Derivatives Division. He advises institutional and wealth investors on ETF and option strategies. Rincon joined TD Securities in 2008, first managing credit risk for the dealer and later as a member of the Equity Derivatives Division. In 2016, he took on the task of expanding TD Securities ETF research platform. We're going to ask Tom and Andres the where, when, what, how these marijuana ETFs can fit into your portfolio. But before we do, I wanted to invite Christian Magoon, founder and CEO at Amplify ETFs, to join the call. An ETF veteran, Christian has launched over 50 ETFs in the U.S. to date. Previously, he served as the president of Claymore Securities, now Guggenheim Investments. Christian launched the Claymore's ETF business in 2006, and it became one of the fastest growing and most innovative ETF sponsors in the industry. Christian regularly provides his investment insight and industry knowledge on a variety of U.S. media outlets. How are you today, Christian?
Hey, I'm doing well, John. Thanks for having me.
Great. It's good to have you here. So, Christian, I know that I got 5 minutes and 5 questions for you, so I want to dive right into it. So my first question for you is, before we dive into those two products specifically, driving your growth, can you briefly explain who Amplify is?
So Amplify Investments is a Chicago registered investment advisor. We're the sponsor of the Amplify ETF product line. We launched our first ETF less than 2 years ago and have just over $400 million in ETF AUM. We tend to do innovative things. In fact, we recently filed for the first blockchain ETF, and we expect the Amplify Blockchain Leaders ETF, ticker BLOK, that's block, will launch here very shortly. So we're excited to be part of the webinar today and talk briefly on several opportunities we think are timely.
Yeah, absolutely. So let's go get into those innovative ETFs that you guys have. Let's start with your top growth story that had a breakout in 2017, an asset growth of looks like 175 million, and performance, the Amplify Online Retail ETF, IBUY. Can you briefly explain the strategy and the why behind how you launched it?
Yeah, so in 2016, we were looking to launch a growth-oriented ETF, and we saw an opportunity. There was no e-commerce or online retail ETF. So we launched iBuy, Amplify Online Retail ETF, and it's an index tracking ETF. it only includes retailers with 70% or more of their revenue coming from online or virtual sales. So quite a unique basket. You know, we're certainly seeing brick and mortars crumbling and online market share continuing to grow. Very unique portfolio, about 85% different than the traditional brick and mortar retail ETFs. And we've seen some success in the marketplace. In fact, last year, iBuy had a 50% return. And believe it or not, Amazon's in that ETF, but it was only the 15th best performing online retail stock last year, kind of showing why a diversified basket approach may make sense.
Yeah, absolutely. That's one of the things I like about ETFs, right, is you can kind of spread your bets across the different market. But what's your outlook for online retail, and where does iBuy best fit in an investor's portfolio?
Yeah, so we're early in on online retail market share, John. Believe it or not, only about 9% of all U.S. retail sales are happening online currently. We see that moving, doubling or tripling in the next 3 to 5 years. This year, 12,000 brick and mortar stores are expected to close. That's going to be wind in the sails of online retailers. So still early innings for those companies. We really think this portfolio, iBuy, fits into growth allocation of investors' portfolios. It definitely is a complement to traditional retail exposure, very, very much a hedge. And then also we're seeing a lot of people use it as an alpha allocation because online retail is quite a bit different universe than some of the other tech allocations or growth allocations that are out there.
Yeah, I definitely would agree with you there that it kind of stands out. I did not know that we were only about 9% in sales. That's shocking. I definitely would have thought that it's higher, but being conscious of the time, I know that you guys have another great ETF, and we want to take the time to ask you a few questions on that as well. So what I was hoping to focus on now is the high income fund that you have there, the Yield Shares High Income ETF YYY. I believe it launched in 2013 and gathered over $200 million in assets while paying a fairly high monthly income. The fund does this through owning a mix of closed-end funds in both the equity and the bond markets that trade at discounts to their net asset value. Can you explain a little bit about how that investment strategy works within YYY?
Sure. There's a big demand for high monthly income. Many investors are trying to reduce their duration. They want to stay diversified. So what we've done is we've created an ETF that buys the 30 highest ranked closed-end funds that have the highest discounts to NAV, distributions, and liquidity. So essentially we're trying to take advantage of closed-end fund discounts, which tend to be a pain if you bought them on the IPO, but can be a significant advantage if you buy them in the secondary. Where generally this fund is buying $1 worth of income for about 95 cents. So what that does is spit out a portfolio of bond and equity closed-end funds that pays monthly. Our current distribution yield is 7.8%, and we've seen a lot of traction there. It's kind of an alternative source for income that I think is very additive to investors' portfolios.
Yeah, and I know within that fund that you guys are kind of doing a couple different things that are unique and specific to the methodology. I believe, like I said, there's 3 of them. How are they different than other ETFs that own closed-end funds? Can you kind of explain a little bit to the audience about those 3 different factors?
Yeah, real briefly, because I know we're tight on time. The unique part of YYY when it invests in closed-end funds is that it looks at some of the highest market cap funds that have significant trading volume, and then the fund rebalances once a year at year-end to take advantage of seasonal tax loss selling, which often presents some interesting discount opportunities that are seasonal. So those are 3 kind of unique advantages that we think help YYY stand out from some of the other ETFs that are out there that access closed-end fund income.
Christian, that's fantastic. I think you may have been just about spot on that 5 minutes. So I want to thank you very much for your time. Thank you for joining us today. Anyone interested in learning more about these ETFs should check out the Amplify ETF website. That is amplifyetfs.com. So again, if you're interested in learning more, please do check out the website. But I wanted to go ahead and bring back in Andres and Tom at this time to talk about our central topic for today's webinar, and that is the alternative harvest, adding the green rush to your portfolio. Guys, I'm going to start with a big question for both of you, and then we can narrow down from here. Andres, you first. Big picture, how should clients be positioning their portfolios for investing in marijuana and the green rush?
Um, from my perspective, ideally it has to be a long-term hold. These, and generally for now, in relatively small positions. These are very volatile stocks right now, and it's a very early industry, although it's been going on for a long time. This is early days from a listed point of view, and it's important for investors to be a bit cautious that these sort of products can have quite a bit of moves. And there are a lot of issues that we certainly will discuss in the coming minutes here. But those issues such as regulation, where they're trading right now, how rich they're trading, amongst many other changes to come, will definitely affect these stocks and the ETF itself. So it's important to be very patient with these names. Like I said, it's an early industry, but surely the tobacco and alcohol and other industries that were, when they were young, they had similar issues.
Yeah, absolutely. Always one of those things that when these come out early, you certainly want to have some caution around them. Make sure you do your due diligence. Tom, I want to turn it over to you, though. Kind of how do you look at 2018 from the perspective of owning a marijuana ETF?
Yeah, so I think he brought up a good point, and it's about understanding that it's still in its infancy, right? And even just bigger thematic investing just become a really hot topic, and it's with MJX in particular, it's hard to ignore it, right? If you look on your screen, actually the best performing ETF year to date, if you take out all the leverage funds, is MJX. It's up 16% this year, and we're only 10 days into the year. So I think as you're looking forward in 2008, it's one thing that was mentioned is like understanding valuation, but also knowing that there's a lot of still unknown regulatory hurdles, right? Like we saw, California, legalized marijuana this week, and then 3 days later, the Attorney General came out. So you're probably going to see a lot of volatility around the news and a lot of headline risk with some of these funds. But I think it's really understanding kind of like the composition of it. So one, if you look at MJX, half the fund's in Canada. So it's also, it's a thematic product, but also understanding some of the byproducts, sector-wise, country-wise, even market cap. So if you look at this fund, most of them are pretty small companies. I think the average market cap's about $1 billion, $1.5 billion. So I think it's definitely something that, something that should be top of mind when you're looking at something like MJX.
Yeah, sounds like
so going back to one of the points you made is also if you look at the inflows in a ticker such as HMMJ, despite it listing and then it going a bit on a lull, flows have sort of maintained its level, and now obviously they've increased given that all these stocks are much higher. But throughout the harder months since it listed, in the case of HMMJ, it maintained its flows in there. So I guess the point is that you have to be, as an investor, you have to be a bit patient with this industry, knowing that it's going to go through a lot of changes, including mergers and acquisitions, and some of them might not work out. So it's a matter of having a bit more patience despite all the volatility and all the thematic news on it.
Yeah, exactly. And with some of these company market caps being small, like I said, a lot of these could be targets for M&As and a lot of news around that, corporate actions. And we even saw last year or late last year, a Constellation brands, like the alcohol company, got involved in this industry. They bought a stake in a small Canadian company. So, definitely be on the lookout for things like that.
Yeah, it sounds like the name of the game right now is certainly patience when it comes to these ETFs. But I want to raise a question along the lines of patience here. Is now the time to get into these ETFs, right? Or if you sit around and you're patient, you sit on the sidelines, will you actually miss the growth? Because we see it as a hot dot right now and a lot of assets kind of flowing into it. Could investors wind up being patient and miss their opportunity? And I throw that one out to Tom to start.
In terms of missing the opportunity, no, I don't think so. I think given it, the thing with thematic investing is that eventually what we like to see is that it's some sort of disruptor, right? So it's disrupting the status quo, whether it's something like robotics or cybersecurity. So again, with it being in its infancy, and then if we do see some investment merit behind it, yeah, sure, there was a big pop, and maybe MJX may be a little bit ahead of itself right now, but I think as we see some of the dust settle around regulation, we could continue to see continued growth in the space. Maybe not, maybe reduce, won't be as volatile, but I don't think it's necessarily, if someone hasn't gotten in now, I don't think necessarily they're too late to the game. I think there's still a lot of unknowns.
Okay. And Andres, anything to add to that?
Yeah, I mean, my view, it's a bit more mixed, if I'm honest. I will look at it in two ways. If you look at it from a purely valuation perspective and where these names are trading today and where the business model is today, you have to start becoming a bit more cautious, just a tad more cautious. But the interesting thing, as many growth industries happen to see, is that there are opportunities where you don't see them. So in terms of production and in terms of amount of revenue that these companies generate in Canada or in the U.S., wherever they operate, they're getting towards those levels where, from an evaluation perspective, they're getting fair value. Once again, depending on a lot of the metrics and assumptions you make, but obviously stuff like international expansion, the growth of medical marijuana in many other countries, that sort of activity you cannot really predict. And that's where really all the growth could happen or could be over the next decade for many of these companies. From a valuation perspective, from the Canada point of view, a lot of these companies are valued right now as if for perfection, let me put it this way, as if production is going to get to the levels that they're saying it's going to get to, and demand is going to be there once production is there. So you have to be a bit more careful with those names with regards to valuations, but once again, it's hard to see what the future holds with such a young industry.
Yeah, absolutely. So one of the things that I wanted to touch on, and this is according to Bloomberg, the alternative harvest ETF could grow to $1 billion in AUM in less than 2 months, which would make it the second fastest ETF to hit that mark. Are we getting into kind of Bitcoin-y, bubbly territory here? Kind of, what are your thoughts there? Is this kind of creating a massive bubble?
No, I mean, I think it just really shows the attractiveness. I think it shows two things. One, just the attractiveness of the ETF wrapper, but also just the attractiveness to that growth sector. We're talking about, we looked at the data, so actually the fastest growing ETF was GLD to hit $1 billion. Bond, which is Bill Gross's fund, took about 2 months or so, and now we're at 300 or so 50 million in MJX. So when you're kind of comparing this towards something like Bitcoin, there's obviously a lot of attention towards ETFs and a lot of things, but it feels a little Bitcoin-y, but I think we just thought that was a pretty interesting stat.
Oh no, it's definitely a very interesting stat. From where I sit, I think that it definitely gives you a second to at least pause and just kind of understand, hey, maybe markets might be getting a little frothy. But, we're running out of time here. We only got about 12 minutes, which seems like a lot of time, but we got quite a few questions to get through. So, Andres, I wanted to open this back up to you. I know we've kind of touched on these a little bit as far as the risks that are associated with these marijuana ETFs, but kind of when you look across the globe, you said kind of the unknown is one of the biggest risks, but what are some of the risks that we do know about, and what should advisors be wary about?
So obviously we talked about regulatory risk, and it's hard to quantify. If you ask me my opinions, I think that in terms of the U.S., that ship has sailed a bit. Obviously from a state point of view, it's already been approved in many of the states, and the Attorney General can move it around as much as he can, and he'll try and prevent here and there. But I think at the end of the day, some of these operations will happen. Also, going back to that point, a lot of the companies that are within let's say MJX, for example, a lot of the companies within there don't necessarily operate to a big extent in the U.S. And they do is a very small name like APH in Canada. They do have some decent-sized operations in the U.S., and they may be more at risk, but some of the other names may be less so. So that is definitely a risk to a degree, but I don't think that is necessarily the highest risk, if I'm honest. From a long-term point of view, if you look at not just the next few weeks, let's say, where you can get a lot of headline risk coming out of the U.S. In Canada, the regulations are going the right way. And the issue with that is that you start getting into the nitty-gritties of the regulation and who's going to benefit from these regulations. In Canada, for example, where many of these companies operate, the government is going to control the flow of all this marijuana and just a supply. And so it's hard to see where exactly these companies are going to be valued when it comes to the margins that they're going to earn, because once again, that's up to the government going forward. And then margins, also how much production they're going to actually be able to make. And that's the other one that I really am more concerned about, saying, well, everybody's pricing these names as if they're going to grow exponentially, and many of them will, especially the large cap ones. But some of the smaller ones that are pretty much small farming operations in the wheat space will or might have a bit more trouble expanding or matching that growth as some of the big ones will. And then that means that the growth in production might necessarily suffer a bit. So I'm a bit concerned in terms of these names is matching their expectations and investors getting exactly what they hope for. But look, it's a brand new industry. It's still unclear what the government will do, and that's something that obviously we have to see. What the government has said also is they've allowed many of these companies to export their product, which opens up a great opportunity for many of these names. So just recently, Aurora signed an agreement with a company in Denmark to transform their tomato greenhouses into marijuana greenhouses so they can sell into Europe. So those growth opportunities, although small still, do represent some positives for the industry. So going back to what I was saying, my main concern is really valuation. They have to, they've run up quite a bit already, and they have quite a bit of optimism in them already. They have to prove to the market that they can get the margins that they're expecting and get the production they're expecting. So that's honestly my main concern. And second would be regulation. Regulation is always a concern, not just in the U.S., but also in Canada and globally. If other countries loosen their regulations, it might invite many of these companies, which are far more developed from a global perspective, to enter their market and sell marijuana in those countries. So that's something also to consider. Those are I would call the two main ones. Go ahead.
Tom, I was going to say, outside of those two, is there something that investors might be overlooking, whether that's kind of the inability to access banks or something that we just aren't giving kind of enough credit to at this time?
Yeah, so
actually,
let's leave this one for Tom.
And actually, ETF.com had a great piece on it. It was looking at some of the operational hurdles of the ETF itself. So, it was looking at, some of these custodians actually didn't want to be associated with some of the negative stigma of holding, cannabis-focused companies. So, it's also, being aware of just regulatory operational of the ETF itself. Not saying that you're going to lose your money because you have claims to the underlying, but just being aware that it's still a touchy subject for a lot of firms, right? Maybe a lot of distributors or custodians or whatnot. So it's definitely something to keep in mind, not just the theme itself, but just the mechanics of it.
And it's a funny story because obviously you have that story on the custodians giving them maybe a hard time for these ETFs, but you saw just this week. Aurora and MedRelief raised money through Canaccord. So obviously these names, not necessarily the ETF, but many of these names are finding financing, whether it be in Canada or in the U.S. So it's still early, and you can see there's two sides to that coin, right?
Yeah.
Yeah, so guys, because we are pressed for time here now, as I said, that 12 minutes would go rather quickly as we get into our questions. The next question I think advisors probably have on their mind is, okay, so I've come to grips with it. I want to use this ETF. Makes sense. I get the story. I get the risk. But where does it fit in their portfolio? So, Tom, maybe you want to jump on that one first, and then we'll turn it over to Andres. But if I'm looking at adding this to my portfolio, is it a core holding? Is it satellite? And how do you guys anticipate this being used?
Yeah, I mean, I think similar with really any kind of thematic ETF that you're looking at, it's likely more a satellite holding, right? probably doesn't make a lot of sense in your core. But if you do have a strong conviction in this industry or in the theme itself, it definitely can be used more as a satellite position. Or a lot of people too in their portfolios have a little bit carved out for these type of themes, so that that's where I think it makes more sense.
Andres, anything to add?
Yeah, I completely agree. I think
Okay.
the satellite holding is where it should be for now. Like I said, it's not just because it's marijuana and because of regulation. It's just at the end of the day, it's a thematic investment right now, and it's also early days, so there's no other place to put it really.
Yeah, makes some sense, and I think that's where most people want to do it, right? Is kind of dip their toe a little bit, see if it makes sense, if regulation continues to be positive, and the overall outlook for an acceptance probably in the public continues to grow, then it makes more sense to continue to hold that satellite position. But what I wanted to talk about is we've talked a lot about the positives, a lot about the risks that are out there. But is there anything right now, if you were holding these ETFs, that could happen that would make you pull your exposure back, same day or something like that? Is there anything, and I don't want to call it an immediate risk, but is there something you'd have to see happen to make you turn bullish on these, or not bullish, I'm sorry, bearish on these ETFs?
I would think more involvement of the government, like more regulatory hurdles, because sometimes that could be a little messy.
Okay. And Andres, how about you? Anything out there that would make you think twice about adding it to a portfolio?
Yeah, so a couple of things. One of the things that we've been watching quite closely is how many of these ETFs have been starting to get they're starting to become mainstream just by being added to many primary benchmarks in Canada. And so WEED, APH are good examples, and in March it will be Aurora. But a good example is APH, which is at risk of being delisted to a degree if the TSX believes that it has operations that are substantial in the U.S., given that it's not legal, right? Many of the clauses for many of these ETFs, including HMMJ and MGX, is that they cannot operate in a broad sense in the U.S., but they can to a degree in some of the states. But it's up to some of the exchanges to see if they allow many of these names to be listed on an index or not. So maybe being taken out of an index is an early indication that the industry itself is not necessarily going the way of these ETFs over the industry. But apart from that, is really regulation in the near term is definitely regulation one that I will watch, because the issue of valuation and production and to see if these companies are valued fairly is more of a long-term issue. So from a short-term point of view, is definitely I will look at it from a regulatory and also from a index perspective, I guess.
Yeah. So, gentlemen, I want to thank you guys for your time. We have just about 90 seconds here, so that's a wrap. So again, I'd like to thank Andres and Time for your time, your thoughtfulness. We really do appreciate you sharing your views. A lot was shared there for the investors to take back and think about. Certainly want to thank Christian Magoon for joining us today as well to share the latest on iBuy and YYY. Again, if you want to find out more about those ETFs, visit the website amplifyetfs.com. Always, I want to thank the audience for taking time to join us on the webinar. We know your time is valuable. We appreciate your commitment that you show to your clients by continuing your education on ETFs. And of course, if you want to learn more about our panels today, please join us down in Florida in 2018 for our Inside ETFs conference. Where you can find out more for the conference by going to InsideETFs.com. Space is filling up, but we do still have seats to register, so please do join us down in Florida. For me here at Inside ETFs, I'd like to thank all of you again. You guys have a great day and continue to use those ETFs to manage your risk and have better investment outcomes. Thank you, and have a great day.